We have a brand new whole life product in Canada. Exciting news, Canada Life has launched a whole life product, single premium for charitable giving. We're going to break it down today, tell you all about it. Hi, everyone. Welcome to Control and Compound with Darren Mitchell. I'm your host. Joining me today, Christina Wyatt. Christina, how are you?
Hey, Darren, I am super excited today. It's not very often that there is a new product when it comes to participating whole life, right? It's been going on the same for a very long time. So this is exciting news.
Yeah, Canada Life started, their first whole life product, 1847. So it's been a while, and now they have a new product coming out. So looking forward to talking about that today.
Yes, absolutely. But before we get started, I just want to remind everybody that if you're listening on your favorite podcast platform, you're going to want to subscribe and leave that 5-star review. And if you're listening or watching on YouTube, make sure you like, subscribe, and hit the bell button so you always know when new content is coming out. And don't forget to follow us on our social media platforms at Control and Compound on TikTok and Instagram.
Love it. Okay, so charitable giving, it's not for everyone, but a lot of people, and increasingly more people. There's a lot of wealthy people, a lot of baby boomers getting older, deciding what they're going to do with their wealth, and then just everyday people that are just charitable people. So we've dealt in this for a while, but this new product is really neat, some of the features of it. But before we jump into the new product, Christina, charitable giving's been around for as long as I've been around in the insurance business. And we've always had it, and there's really been two different ways we could do it. Can we just kind of talk about the two different ways that charitable giving has been around for the last number of years and break down the differences?
Yeah, so charitable giving has been big in the life insurance industry for a long time, and we use it for two different reasons. The first one would be estate planning. So what we can do is we can set up a policy. You own the policy. You pay for the policy as the donor. When you die, a death benefit is going to pay out, and the beneficiary is going to be named as the charity. And the beneficiary, who is the charity, is going to receive that, and they're going to issue that tax receipt to your estate. So this is an estate planning tool. This is going to reduce those taxes on your estate at the time of death, and that's one option and one way to do it.
Okay, so let's say, let's use an example and say, let's say it was $20,000 a year premium for 10 years, and the death benefit was $1 million. So you're telling me in that situation, the $1 million gets paid out at death to the charity, and the individual gets $1 million tax deduction.
Yes, their state.
Their state gets $1 million tax deduction. Well, that would take care of a lot of bills at death, wouldn't it? Or a lot of taxes at death.
Yeah, so it's going to be a charitable donation receipt that they're going to be able to put in there. So yes, very advantageous. So that's why a lot of people do it.
Yeah, very cool. Okay, so that's scenario number one. You really don't get any tax deduction, but your estate gets a big, massive tax deduction. Yeah. And what's scenario number two that we currently have?
So the second way that we could do it is the charity would actually own the policy. So the charity is going to own the policy. As the donor, you are going to pay those premiums each year. So if it's 10 years, 20 years, you're going to pay those premiums each year. And every single year that you pay that premium, you're going to get a tax receipt for those premiums. So that's more of a living thing, right? So we're going to get those tax receipts each year to go towards our income, but we're not going to get that estate. We're not going to get that tax receipt to our estate because the charity's the owner. The charity's still going to be the beneficiary, but we're not going to get that one. We're going to get them while we're living. So it's a different type of planning.
Okay, so in the second scenario, you don't get the $1 million charitable gift for the estate that you can use, but you get, in my example of 20 grand, if your premium was 20 grand a year, every year you have a tax deduction of charitable donation of $20,000 a year.
Yes, exactly. Yeah. So those were our two ways to do it. And you were going to be making these deposits for 10 years, 20 years, lifetime. So that has been, that's historically how we've been able to give to charity through life insurance. Pretty great though. Works very well. You get more money to your charity than CRA. So we'll take it, right?
Yeah, I love it. Okay, so now we have this brand new charitable product coming out, single pay. Everyone in the insurance business is talking about it, the buzz. Christina, let's start from the top. What's this product and how's it work?
Okay, so this product's called My Par Gift. They named it. It's specifically for charitable giving, nothing else. So those other products we just talked about, they're your regular products that we always talk about. This is called My Par Gift, and what it allows you to do is a one-time premium. So this is the only place that we can do this. We tell people all the time that you can't do a one-time premium, and with infinite banking, you absolutely can still not do a one-time premium, okay? But with this one, because it's charitable giving, they're gonna allow us to do that. So you can put, let's say, the minimum's $10,000. So you have to be able to put at least $10,000 into this policy, but it is going to completely pay it up. You're gonna put the money in, you're gonna receive a tax receipt for that year, a charitable donation tax receipt for that year, and the charity's going to own it, and the charity is going to receive the death benefit. And the really cool thing about this is that Canada Life's actually going to work with the charity on everything to do with it. So it's like a one time, you do it, you get your receipt, it's put in place for life, and you've really enhanced what you were going to be giving to that charity otherwise, which is neat, right?
Okay, so let me walk through this. So instead of paying, X amount, 10, 20,000, whatever your number is per year for 10, 20 years or life, you can do one lump sum check. You get a charitable receipt for the whole amount of your check.
Yep.
Whatever your one-time lump sum is, that entire amount is a charitable receipt. And then at that point, you don't own it. The charity owns it, and the charity is going to receive the death benefit, right? There's really no other. Is there advantage for the charity before the death benefit gets paid out?
Yeah, so because this is a participating whole life policy, dividends are going to pay, right? There's going to be cash values associated with this life insurance policy as well. And with the charity owning the policy, they can access those cash values early. So if they need to, use those, they can take the policy loans, just like what we talk about. They can take those policy loans, and it will just be subtracted from the death benefit. They can also take withdrawals. Their charities are completely tax free, so lots of things that they can do, but they have access to it early on, or they can hold on to it and have that death benefit.
Thanks for listening so far. If you're watching on YouTube, make sure you like, subscribe, and hit that bell button so you always know when new content is coming out. If you're listening on your favorite podcast platform, please leave a 5-star rating and leave a review and subscribe. And if you are interested in learning more, please visit our website at controlandcompound.com to sign up for a free education session with one of our wealth coaches.
Love it. Okay, so Christina, I think it would be useful if we went through an example. So can we just do like an example? I'm guessing you have one there.
Yes. So I do have one here in hand for an individual. So this is we're just doing the numbers based on a 50-year-old male. So a 50-year-old male non-smoker. And we're going to say they want to put in $100,000 deposit. So they want to put $100,000 in for their charitable giving. They want to give it to their favorite foundation. Keep in mind, these have to be registered charities for it all to work, just like in any other charitable giving. But they want to give it to their charity. So they say, I'm going to give $100,000 to this charity regardless this year, because I have to do it for my taxes and to give back. But instead, I'm going to take out this life insurance policy. So I'm going to take out the life insurance policy with me as the insured, and then I'm going to make the $100,000 deposit. That year, he's going to receive a $50,000 tax savings from the donation, right? So he's going to get that charitable tax receipt for that year, the year that the deposit's made. Canada Life doesn't issue those receipts. The charity's going to issue that receipt to you. So your after cost donation is $50,000, right? So he's paid $50,000 to be able to do this donation. And the charity has gotten $100,000, but not actually, because immediately after putting this $100,000 in, the death benefit is $160,000. So from day one, this donation has increased by $60,000. Because it's a participating whole life, it's also going to continue to grow. So it's not just going to stay there stagnant at $160,000 each year. It's going to receive that dividend like they always have paid. And the insurance cash values at year 15, or actually, so insurance cash values at year number 1 are $35,000. So like immediately there's cash values if the charity needs to use them as well.
Sorry, what was the cash value year one? No,
Yeah, year 1, the cash values are $35,000.
Wow. That's great.
Yeah. guaranteed cash values year one. So the charity can absolutely use it early if they need to. It's going to be available to them, which is really nice.
Okay. And then they leave it in there. So you were talking about by year 15, it grows.
Yeah. So if we look at year 15, your cash values are now 98,000 if they need to use it. Your death benefit, you're 65, your death benefit's 258,000, continuing to grow again, right? And by age 90, we have a $643,000 death benefit. So you die, you put 100,000 in, you got your tax slip, everything, $50,000 is pretty much what you paid out of pocket for this. And your favorite charity, your foundation, that place that needs it is now going to receive $640,000 tax free. It's huge.
Wow. So after tax, it cost this donor $50,000. They put in 100. They had a charitable donation, cost them after tax net 50, and the charity could receive at life expectancy or whatever we did, 85 or 90, over $600,000.
Yeah.
That's amazing. Amazing. Okay, Christina, what about the downsides? Are there any downsides here from the individual? Can anyone do this, or is it still like all other insurance? There's a few questions are asked.
Yeah, so it's like any other life insurance application that you have to take. You do have to be insurable in order to do it, so you have to be able to get that life insurance. Now, that's not to say that there's not somebody that is insurable that can be used too, right? As the donor, the insured is the person that death benefit pays out on, but you can be the donor and make that, pay for that premium without being the physical insured. But we do need a body. It's life insurance. So we need a healthy body in order to put this in place.
We're gonna find one healthy body to put the insurance on. Okay, so if I want to make a donation and I'm not insurable or I'm past the age I think I'd want to qualify, I can choose another life and I still get the donation. Charity still gets the death benefit, and that life insured really, helps out the charity, but doesn't benefit from that because the owner gets the donation, the charity gets the death benefit.
Yes, and the cool thing too is that corporations can do this, right? So if you want to make a corporate donation, you still need a body, and typically it's a controlling shareholder is who they want to see as the healthy body. But yeah, we can do a corporate donation as well, so the corporation can get that charitable tax receipt.
So in that same scenario, the corporation gets that $100,000 charitable receipt. Year one, not waiting till death. Year one, they're going to get that receipt.
Yes. Yeah.
No, sorry, we said 100 grand. What was the minimum again, Christina?
10,000 is the minimum that you have to put into these. And we can't split charities either. So if, you wanted 50,000 to go to one charity, 50,000 to go to the other, we can't do that. We would have to set them up separately because Canada Life's going to be working with these charities to make sure that they have everything they need, which is kind of cool on Canada Life's part to take that on and work with them. But they do say individual policies for each charity that we're working with. So if you wanted it to go to two places, we'd do two.
Yeah, and it's gonna be a registered charity, right? Like,
yes.
Now, we have clients that have family foundations, right? That are registered charities. So, you could have the, Wyatt Family Foundation, whatever, and then people are making donations to these. Again, it's not the insurance company that gives you the receipt; it's the charity. So we got to coordinate everything with the charity, with the insurance company, and then we help you coordinate all those. Anything else, Christina, that would raise a flag? Like, this just seems like a fantastic product if you're charitable minded to make X 10 or 11X as far as your donation. Anything else to add, Christina?
Not from like that. It's pretty straightforward stuff. Like, it's not complicated, which I also like. They've made it very easy for people to give back. And sometimes I find when people are looking at complex estate planning and adding the charitable giving to it and stuff, it can get a little bit overwhelming. And you're like, oh, I'm just going to back out on that. It seems to be a bit much. Whereas they've really simplified it for people. One time, you put the money in there one time, and they're going to receive that tax receipt that year, and it's going to be done for them, which is nice. There was one little thing that I did read about is just making sure you're coordinating with the registered charity to get the tax receipt in the year that you want it. So sometimes our annual anniversary dates aren't January. all policy dates aren't January 1st. So you want to make sure that that's coordinated so that you get the tax receipt the year you want it. But I think it's pretty simplified, pretty solid. There's not a ton of bells and whistles to make it overcomplicated, which I like. I think it's actually going to get a lot more people thinking about giving back and giving to these charities, right?
Yeah, I like it just because it's that single pay, right? Like, yeah, you can set up a charitable policy, but I got to pay for 10 years. And what if things change? Or what if I don't want to by year 7 or 8? Well, here it's just great. An amount you're comfortable with this year, one-time payment, and then it's done. And you've just multiplied that number big time to really help that charity you give about. So, Christina, one of the real-world applications of this, we know families with charitable foundations. Well, you can start putting this on grandparents and then the parents and then the child. And you do that a couple generations, like you're now setting it up now. By the time these death benefits are roll out, it's going to systematically fund this charity for in perpetuity. So if you have a family foundation and you want it to go on forever, this is a great way to start insuring multiple generations. So the grandparents die maybe in a few years, the parents die in 30 years, the kids die in 80 years, their kids die, et cetera, et cetera. So we really get that multiplication of that family foundation. It'd be pretty cool to have a family foundation that was really self-fulfilling, and then you could just do all the charitable good work that you wanted to do, knowing the funds are there.
Yeah, absolutely. And it's infinite, right? It's just like what we set this up, generational wealth transfers on the other side using our infinite banking. And this product is really giving us the tool to set up an infinite foundation, right? Like if you have this structured into the foundation where when a new grandchild's born, a policy, maybe it's set up so that every time a new grandchild's born, that foundation purchases the policy, and then it's going to go back in. You have infinitely set up this foundation to continue on for a long time, long after you're gone, right? I love that. It's awesome. It's a really cool thing, that a tool that we can use that's super uncomplicated and easy to put in place. So yeah, love it.
Love it. All right, brand new whole life product, single pay, charitable giving. You want to learn more, reach out to us at Control and Compound. Have an awesome day. Thanks for listening to this podcast. If you're listening on YouTube, please like, subscribe, and hit that bell button. If you're listening on your favorite podcast platform, please leave us a 5-star review and subscribe. And if you want more information, check out our website, controlandcompound.com, and you can sign up for an education session with one of our wealth coaches.